Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us as we take a look at options trade management. Now, I hear Russell breathing in the background. Always good to know that you've unmuted
that means
your phone.
He's going to chat with you for a second.
Well,
put a little fear
Russell.
into you.
Uh-oh.
Do you know who I'm meeting today?
Oh, dear. Who are you meeting with?
Who influences more about your world than anybody else? Thomas Petrie?
Petterfee.
Petterfee.
Oh,
yeah,
my goodness.
Yeah.
Oh.
They're doing an option leaders webcast here to celebrate 40 years of CBOE, 30 years of index trading, 20 years of VIX. And he is going to be with our chairman, Bill Brodsky, Larry McMillan, Stephen Sears from Barron's, and Myron Scholes, of all people.
My goodness.
On a panel. And and if anybody out there is, I never do this, but I'm actually going to go ahead and do it. If you want to watch it, you can actually watch it through our website starting at 4 Central. If you're out and about and you follow us on Twitter, I'm actually going to be sitting on the front row and tweeting anything they say that's significant. So it's kind of a pretty cool deal. It's one of the coolest things I've gotten to do in my career is just me on the front row. So.
Oh, well, thank you for that notice.
And unfortunately, I've been in the classroom all morning, and I didn't get to give you a heads up that I was going to do that.
Well, thanks for letting us know, but also everyone in attendance too. Yeah. Mr. Petterfee does not get out and about often, so it's good to have him. Also, I'd be interested in following that.
Okay.
But we're actually here today to talk about options trade management. Okay. So with that, I'm just going to move this over to your slides, pass you the ball, and let's get started.
Okay.
Thanks, Russell.
You betcha. All right. So, I'm going to have to pause for a second. I've been putting this on a new computer, and it is setting something up while I have the ball just passed to me. So nobody can see this but me. And here we go. Okay. So yes, I am here not to talk about something that's going on later, but option trade management. Before we get going, here is my disclosure statement. I'm here for educational purposes only. I'm going to use a couple of historical examples from just a couple of weeks ago in the markets, but I'm not making any recommendations, not saying go out and follow this strategy over and over again. With that, I think everybody's good with those instructions. I'm just going to run through trade management, how you might have a plan before you get into a trade as far as what you may do over the course of a trade. And with option trades, it's a little bit different decision than it is maybe with stocks or futures. Before I joined the Options Institute about 4 years ago, I was actually trading nothing but financial futures for about 5 years. And trade management for me was profit target, time exit, or some sort of stop. In the option world, there are more alternatives, a lot more alternatives as far as trade management goes. And getting in and then possibly getting out, that is always one choice, but there are also situations where you may want to roll a transaction, and that's what we're going to talk about mostly today. I'm going to give a couple of trading examples where things work well, things maybe didn't work well, and what decision was made. And then we will summarize, and I'll do my best to answer any option-related questions. We're kind of talking about a niche topic today, so if you've got other option-related questions, throw them in there at the end, and I'll do my best to address them. I also think that, and Cynthia and I talked about it a while back, I think she's going to come on and maybe show how to go about doing a rolling transaction with, and I want to see this as well because this is another thing that we keep to ourselves. I'm actually an IB client. I've been with them for 14 years now, so I always like doing Interactive Brokers webcasts because I've had that relationship with them, gosh, almost a third of my life. So, before you do any option trade, I often, when I'm teaching classes and somebody asks me something, and I'll be teaching a class in a ballroom on behalf of the OIC or on behalf of the Chicago Board Options Exchange, and I'll often get a question like, what do you think of the June IBM 210 calls or something like that. And my response is always that in the form of a question. And the question is, what is your price target for, I used IBM there as an example. What's your price target for IBM? Where do you think the stock's going? Do you think the stock's going to stay in a range? That's a price target, or that's a price forecast as well. And what's the time frame of your price forecast? And then a third component, if you're thinking about buying an option for just 2 or 3 days, you might need to have an implied volatility outlook as well. So before every trade, and I was teaching an intermediate level class yesterday, we ran through, what goes into making an option trade decision. What you also should have in the back of your mind, or maybe even down on paper, or something that you have resolved yourself to do in the future, you should also have some sort of exit strategy. You should have a reason for doing the trade. You should also have in your mind, what are you going to do if the stock doesn't do what you expect in the case of an equity option trade? What do you do if implied volatility does something different as well? There are lots of moving pieces. There are lots of moving pieces to all option trades. There are lots of moving pieces that can go along with your exit strategy as well. Positive outcome, you've got a target price. That target price could be based on the option. It can be based on the stock. I've heard both. I've heard arguments on both sides. And I'm very open-minded about everybody having different methods of trading and having their own methods that work for them. Personally, I always base my, I always base what I'm doing in the option world on the stock price. It's just how I've traded, and that's how I will. I'm so old now that I am set in my ways, and that's the way I'm going to stick with things. I know on the positive side that there are other instructors here at the Options Institute that will base getting out on what happens with the option contract or what happens with the value of a certain spread. That's what they are shooting for. In addition, they may have a stop based on the option price or maybe the value of a spread. I like to, again, just the way I go about doing things is the second bullet point. I tend to judge what I'm going to do with an option trade based on what's going on with the stock price. Now, that can involve, having what I refer to as a mental stop. And you can, that mental stop may be based on, breaking a certain support level in the case of having a long bias trade, might be based on breaking out if I have a short bias trade on. Another part of the negative outcome is I expect, if you have an outlook for a stock and you expect a stock to do something over a certain amount of time, maybe it's based on an event, or some sort of occurrence. Well, the negative outcome, I put it under negative outcome. I almost put it under both. But if you've got an expectation for a new product announcement or an earnings announcement, one of the exit strategies should be based on getting out after that news has hit the market. I also know that in the case of certain spreads, that there are spreads that there are educators out there that like to use delta as an indicator of when to possibly roll a transaction or when to actually exit the transaction. And as I just mentioned, the exiting can also mean a rolling transaction, and whether or not you're going to roll a position will come into play based on how much time is left to expiration and what kind of premium you might be able to gather from the rolling transaction. So we're going to talk about rolling transactions a little bit and talk about the reasons that we may do a roll instead of exiting a trade. Rolling a position, it's an alternative that exists in the option world. That's an alternative to exiting a trade. It's one of the great things about trading options is the bigger variety of alternatives you have when the market is going against you, going for you. typically a rolling transaction is going to involve exiting an option position or maybe even exiting a spread and moving to different strikes or different expirations. It's almost like three-dimensional trading because you've got a time component and you've got a strike component. Rolling out generally just refers to rolling to a farther expiration, and then rolling up or down is the term that we use for moving to a different strike price, either a higher strike price or a lower strike price. So now I'm going to give an example just of rolling out. I'm going to use a real stock, one of those stocks that everybody likes to talk about and pay attention to, and most people probably participate in the product a little bit, some probably more than they should. But Facebook, let's say we are short one of the June 27 calls, and we get close to June expiration, and we decide that we would like to maintain a short position in that call option, but maybe we're concerned that the stock will be over 27 at expiration. We don't want to expire in the money, or we or we just want to have a position in July and it's time to move on from June. We may just roll out to the 27 call. You would buy back the June 27 call for 35 cents and take in $1.05 by selling the July 27 call. We get a net credit of 70 cents in that case. And what we've done here is we've just rolled out. We've extended our short exposure in the 27 strike call option from the June expiration to July expiration. We could also decide, maybe we've got that July option contract, the stock starts to move higher, and Facebook starts moving up, and the July 27 call, the premium has gone up, but we're also concerned about, again, this option being in the money at expiration. We're worried about the assignment risk on that option contract. So we could consider rolling up to the July 28 call. Now, in this case, we're actually going to do this at a cost or a debit. We would be buying back our July 27 call, paying $1.50, and at the same time, we would take in 95 cents for the July 28 call. We've taken our, depending on where Facebook is trading, we've actually taken our potential exposure, assignment exposure from 27 to up to 28. And now we're going to run through just a trading example and why we why we would consider possibly rolling up. Let's say we're long 100 shares of Facebook and we're short one of the May 10th 27 calls at 45 cents. This intent, and this is generally why you would have a plan in place about, this is why you would have a plan in place regarding what to do with this short call option. In this case, the intent of the trade is income. We don't want our shares called away. So because the intent is income, if the stock gets up above, if Facebook trades up above 27 and we get close to expiration, we might actually be a little concerned with, having our shares called away, and that was not the intent of this trade. So we're going to roll or exit based on the risk of shares being called away, and a couple of things that will figure into this is how much time do we have left to expiration, and what kind of premium we might be able to get for a farther dated option or a or a higher strike option as well. So here we are. It's Friday, May 10th. Facebook's traded up to 27.65. That's the option that's getting ready to expire. And with the trade up, or with the stock up at that point, we need to definitely get out of the 27 strike call and move into, maybe move into a different option contract. In this case, we've got an opinion on Facebook, and every option should, every option trade, should be based again on that price outlook for the underlying stock. So because we think Facebook's going to trade down soon, we think the stock's ahead of itself, we decide just to roll out the short call to another expiration. And the May 10th position, we're long 100 Facebook at 27.65. Now we're short the May 10th 27 call. It's trading at 70 cents now. It's only got about a nickel of time value. What we actually decide to do, because we'd still like to have some short exposure from and take in some more income from the 27 strike calls, we're actually just going to roll out to the May 17th 27 strike call. And we'll be able to do this at a slight credit. There's a little bit more time value in the slightly in the money 27 call. So we actually would be able to take in 20 cents as we rolled this transaction out. So that's a first, that's a trading outlook, and that's why we would consider rebalancing, reworking our short exposure. Here's another example with a covered call. We've got a covered call. It's Monday, May 13th. Facebook's already traded up to 28.30. We're still long 100 Facebook, and we're short that May 17th 27 call. It's gone up to $1.35 now. Now that the stocks continue to work higher, we're going to have to roll up to a higher strike price, and so between now and May 17th expiration, do we think the stock price might end up below 28? Sure, we think it's going to stay below 28, but above 27 between now and May 17th expiration. So we're going to decide we're rolling up to a higher strike price. And the way we're rolling up, we're basically going to buy back that 27 call and roll up to the 28 call. So, and this one's going to cost us a little bit of money. It's not going to cost us nearly as much money, and that's one of the benefits of rolling as well. It's not going to cost us as much money as it would have if we had not rolled up to another option contract. So, covered call. Facebook's going to close at 27.50. We were dead on with our forecast. I love hindsight forecasts. It's great for teaching examples. So how did we do? Well, we started out, we sold the May 10th 27 call at 45 cents, and we bought it back at 70 cents. So that didn't work too well for us, 25 cents of loss. We sold the May 17th 27 call for 70 cents. We bought it back at 90 cents. But we finally, we managed ourselves to eke out a small profit. And remember, I've probably done 30 or 40 webcasts now for Interactive Brokers, and a ton of my examples are all very nice, smooth profits. And in this case, through a little frustration in the stock not doing what we really expected, at least the first two times out, we were able to eke out a small profit. If all had gone very well and Facebook had just stayed under 27 on May 10th, I wouldn't have a whole lot to talk about now, would I? But as far as, this is more about rolling a transaction or exiting when things aren't working your way. Net options, about 10 cents. And we also were up slightly in our Facebook stock. A covered call is often taught as a strategy that you hold until expiration. It's often taught, and it's the third strategy that we teach in our beginner class. And we always teach it, hold it to expiration, and here's what happens. The stock's either called away or the option expires with no value. Well, when we start to talk to intermediate traders, we also start to talk about the dynamic nature of covered calls and how it is actually an active strategy, especially when you're trading a covered call for income. And in this case, our plan was, to either roll out when we got close to expiration and then maybe roll up when the stock reached a certain level. So now we're going to talk about a little bit more of an intermediate type of trade. In this case, we're going to be bullish on Home Depot over the next few weeks, and we're going to enter into a bull put spread. planning on rolling up the short put. This is actually a positive situation. If Home Depot trades up to 78, and we've also got the other side. If Home Depot trades down to 72.5, we're going to plan on exiting the trade. That's kind of our that we've done our great Gann and Fibonacci analysis, and these are the price levels that we came up with. So with Home Depot trading at 75 3/4, and we continue to think that Home Depot is going to trade higher into June expiration, we're putting on that bull put spread. And for those of you that aren't familiar with the bull put spread, that involves selling a higher strike put, buying a lower strike put, and you take in some income or take in a credit. In this case, we take in $1.30 of credit, and if I were showing this without rolling transactions, I'd be showing holding this trade until expiration. But we're talking about rolling transactions, and the goal here would be for both options to expire with no value. If the stock stays, if Home Depot stays above 75, both options will expire, and the net credit of $1.30 that we took in would be a would end up being a profit. However, we've got some other steps that we would like to do, and this is actually something that I like to do with vertical spreads. I like to trade vertical spreads. I spend about 50% of my time away from the office, away from the market, so I like vertical spreads because I have that defined risk and reward. I also, if the stock starts moving in my direction, I also like to do what I'm going to show you right now, which involves possibly rolling up the short option and doing so to take in a little bit more money. If I've got a trending stock, in this case, Home Depot, I got a perfect outlook on Home Depot. It trades right up to 78, which is what I said it would do. And what I get to do here is actually buy back that short June 75 put and turn around and sell, the next strike up, which is the June 77.5 put. At this point, I believe Home Depot is going to stay above 77.5 through expiration. And this is what I've done through scenario 1 so far. And Chris, good question. I appreciate that. Actually, yes, I would leave the June 70 put alone in this case. And I am aware that by leaving the June, I backed up to use the good illustration here. In my case, and this is, I've done enough webcasts with Interactive Brokers now that I feel familiar with everybody. And it is still a bull put spread. What I've done is I've only rolled up the 75 put to the 77.5 put. I've kept that 70 strike put on. I could roll the whole transaction. Another alternative could be if I don't want to have $7.50 of risk, if maybe I could take that 70 strike put and roll it up to a long position in the 72.50. And in fact, just guesstimating option premiums, if I were to roll that 70 strike put up to a long position in the 72.5 put, it would probably cost, I don't know, 20 cents or so. Let's just say that option would probably be trading at 25 cents. And in fact, being very dynamic, you got me on a roll here, Chris. Being very dynamic, I actually, might consider if the 70 strike put is only trading at a nickel and that's all I can get for it, but I'm worried about the excess risk between 72.5 and 70. You might just consider paying 25 cents for that 72.5 option, and you'd actually be long 2 puts. Let's just call at this point with Home Depot up at 78 and a couple of weeks to June expiration, let's call that 70 strike put kind of a lottery ticket if something goes wrong. And along this discussion that we're having, a good discussion about this bull put spread, your margin would increase a little bit because now your maximum risk, if we just have the, and I'll show I'll show the transactions and where we're at now. Now that we're long the 70 put and short the 77.5 put, you've got more dollar risk. We've taken in $2.10, but if Home Depot pulls a reversal on us and trades down to 70, and we're long the 70 put and short the 77 put, our maximum potential loss here is $5.40. So your margin would increase a little bit on this trade. So good points all around. We showed the good scenario. We've got to show the bad scenario. Scenario 2, we're about halfway. I think I priced these options out on May 17th or the middle of May, and I'm making this assumption that we're halfway through the trade and we got to that target price of where we wanted to roll halfway through the trade, early June, and we've gotten to the price that we consider kind of our stop price. And in this case, you can see the bad scenario, Home Depot is traded down to 72.5. Our current position now, we are short one of the June 75 puts at $3. We are long one of the June 70 puts at 50 cents. We're going to get out of the 70 put. We're going to take in 50 cents for that, and we're going to pay $3 to get out of the 75 put. This was our hard stop and exit on this trade. And remember, we had these price levels, 78 and 72.5, and what we were going to do pretty much set in stone when we initiated the trade. That's the proper way to trade, is to have your exit strategy in place. So this is what's happened here. Stock traded down to 72.5, and our net loss on this trade is $1.70. We made a whopping 5 cents off of the long 70 put, and we ended up losing $1.75 off of the short 75 strike put. So our net, we had taken in $1.30, and we ended up with a net loss of $1.70 on that trade. So open option positions, you can always exit them, you can always roll them. You should have that plan in place, and there's a lot of pieces. It's not like you hit a certain price and you exit your long stock. It's we hit a certain price by a certain date, maybe we roll. The first Home Depot example, if we ran up to 78 and it's just a couple of days until option expiration, we might not, because there might not be a lot of premium in that 77.5 put. So there are other variables to weigh. I've gotten into debates about what's better, looking at the option, looking at delta, looking at price, and encountering thousands of traders, all with different opinions and different strategies throughout every year. I have learned it is best to respect everybody's methodology because they've probably put a lot of effort into and have a lot of belief in whatever their methodology is. For mine, it's based on the underlying stock. I think that has a little bit to do with my my professional background and also the amount of time that I can spend in front of a screen, which is not as much as I'd like sometimes. So. With that, Chris threw some good questions out. If anybody has more questions regarding rolling or planning out your trade, if you're watching this as a recording, feel free to use that email address. In fact, this afternoon, if you've sent me an email in the past 2 weeks and haven't gotten a response, you'll probably get a response this afternoon because today is email catch-up day. And also with that, I see Cynthia coming around as well. She is going to she's going to show us how to use the platform. And when I say
reading my mind.
and when I say us, honestly, it is a collective us because the way I roll transactions right now and the way I enter spread trades, I didn't do it by reading a manual or anybody telling me. I just kind of did it by trial and error, and I'll bet you there's a better way, and I bet you I'm going to learn about it in the next 20 minutes.
Oh boy, pressure is on. Okay, well what I'm going to do, everyone, is share I've grabbed the ball from you, Russell. I do want to go in and share my desktop because at IB, we have a tool for that, for rolling your positions forward. Now, you'll see your screen just blank, but you should be able to view my screen on your desktop right now. And I'm actually looking at our Mosaic interface. There's two different interfaces. Either use our pre-formatted workspace, which is Mosaic, or we have an advanced order mode, you'll see down here, which is our legacy TWS spreadsheet-like interface. Now, either one that you use, you can access, notice here, I'm going to go into more advanced tools, and there's a rollover options tool, adequately, or appropriately, I should say, titled. Now notice when I pull this up, it actually opens up a separate window, and this too is available as well from your advanced order mode. Now notice that you can both write options if you have any uncovered positions. This is a great way to take a look at writing options or to cover those long positions. But notice here, I'm going to go to the rollover tab. Now when I pull up the rollover tab, what you will see is you can select those options that you want to roll. Now by default, you'll see that any options that you have in your account will be presented in this list. Now you can roll the calls or the puts that are expiring in the next X amount of days. Now what I'll do here is we'll just go to 30 days. And also notice that the next section here is where do you want to roll those options to? Now, notice that drop-down box. There are 3 selections, and by default, it will go to the nearest expiration. Now, for some of you, especially depending on what options you are trading, that could mean weekly options. So just do be aware of that. Now, there's also monthly options or the nearest quarterly options. Well, let's go with the next or the nearest monthly options. Now, also, as Russell was explaining, you have the ability to roll to the same strike price that is currently existing or to a strike price that is at least a certain percent above the current market price, above or below, depending on which options you're going to roll. Now, once you do make that selection, simply choose to refresh the list, and you'll see those options that are currently included in your account. You'll also see that roll to date or roll to selection here. Now, based on your inputs up on top, TWS has determined which options to roll to. But notice there is that pencil icon that you can actually click on that. It will open up a version of our option trader or just our option chains, and you can actually select from here those options that you do want to roll forward to. Now, once you've made those selections, notice here I'm just going to go with the default as I selected them, but you can then create orders. Notice here there's an order type. You can set the limit price to the bid or the ask for each of those option contracts, and also create an offset if you desire that. Now, what I'll do here is simply choose to create those orders, and notice what happens. I now have those options in my account. By the way, that May 31st option or the half strike price here is not available, so I would have to use that pencil icon and make that selection. But so I do want to show you that what we've just created are 3 different calendar spreads. You'll see that the contracts that you own will either be bought or sold. What we're actually doing is creating a calendar spread for each of the options in your that are available in your account. Now notice there the current bid and offer indicated with that pink tick dot is showing you what that implied spread pricing is at. You can either choose to, and notice that it does let you know whether you're going to be buying or purchasing those contracts, depending, or that spread, and you'll also see a limit price. Now do be aware that negative limit price for your trade actually indicates that it would be a credit spread. Now from here you can choose to transmit all at once or transmit them individually. So easy to do within the TWS rollover options feature. Now, I'm not seeing any questions, so I did want to quickly show you that. But what I will do is take it back over into our main event window. And if you do have any questions for Russell at this point, please go ahead and enter them into the chat. Looks like Yaroslav has already come in on that calendar spread.
Yeah.
Very good.
Calendar spread's a great trade. And the reason I say it's a great trade is because it takes advantage of time decay. And I have all these different little philosophical things about the markets and how individuals can succeed in the markets. And one of the things that I really believe, beyond proper trade planning and following your rules, one of the things I'm really a big proponent of is in one way or another trying to take advantage of time decay. I just think it's one of the ways that I'm not saying that all you do is sell options to take advantage of time decay, but I don't think individuals will get very far in the option world if all they ever do is buy options. I think you want time decay working for you either through the course, through a spread, or through a or through just like selling a call option against a position or something like that. I'm gonna change the color here so I can type. I'm actually gonna show you something kind of funny about the time decay of option contracts. If you let's say we've got a 7-day, a 14-day, a 21-day, and a 28-day option contract. We've got one of these serial weeklies, and we've got an at the money. Well, it's going to look a little funny. Oh, I was typing and then it got funky on me.
Oh, we weren't seeing your typing, so
I
passed you the ball.
Oh,
now we do see it.
What do you see?
7-day, 1. And
okay.
then I also see 14-day, 21-day, and 28-day.
Okay. So so here we go. If you have an at-the-money option contract, and you've got a 7-day, 14-day, 21-day, and 28-day expirations available, like Robert wrote the IWM in there. The 7-day at-the-money option contract, if it's trading at $1, the at-the-money call, you're thinking about selling a call because you think the market's going to be dead or maybe even go down a little bit. A comparable 28-day call, and we're just making an assumption that the implied volatility is the same going out. A 28-day call with the same strike price and the underlying at the same level you'd only be able to take in $2. As 7 days pass, if the underlying doesn't move at all, that 28-day is going to become the 21-day option, and 27 cents is going to come out of that option contract. $1, the whole value, because this is an at-the-money option that's going to expire at 0, $1 is going to come out of that 7-day contract. Especially with now that we have weeklies. I've been doing a lot of work on weeklies lately. This time decay that you get toward the end of life of an option or over the last week or so is, you get a lot more bang for your buck than the 7 days between 28 days and 21 days to expiration. A calendar spread would sell the 7-day option and buy what is the 28-day option to try to take advantage of this time decay difference. What you may end up doing, let's say you bought the 28-day call because you felt like the market was going to stay flat and you'd only have 27 cents of time decay. You may have to do some sort of managing action with the 7-day option if the market trades up. That's, maybe you have to roll up to the next strike or something like that. So that's rolling within the calendar spread, and this is why you would consider doing a calendar spread on a very, very basic level. Also, this is for the really math adept people out there, this option has 4 times as much time left to expiration as this option. This option has 2 times as much time left as this option. That's the square root of 2, that's the square root of 3, and that's the square root of 4.
Russell, would you use your pointer? We can't see your cursor.
Oh, I was pointing.
How about grab the
there we go.
There, much better.
Yay! So, all right. So what I was saying is, see, the 7-day option has, this 28-day option has 4 times as much time left to expiration as the 7-day option. If you take the square root of 4, you actually get 2. So this is 1 time period, 2 time periods, 3 time periods, and 4 time periods, each time period being 7 days. That's the square root of 1, that's the square root of 2, that's the square root of 3, and that's the square root of 4. That's kind of for the math geeks there, that's actually mathematically how time decay for at-the-money options works for you. If we went out to a 56-day option, the premium on that one would be the square root of 8. It wouldn't be $4. It would be something probably with a 2 handle on it still. The time value of option contracts, time decay you get, the bang for the buck you get, really kicks in. We used to say 30 days to expiration because very often that was the next expiration. Now it's 7 days to expiration. The options that come out tomorrow morning, or the ones that already expire the following Friday, are you got to get good time decay from those. So that's a little description on the calendar spread. And again, you would have, in my case, I would have a price outlook for the underlying, and then I'd have a price outlook for the underlying that might involve rolling up or rolling down as well. Jason's asking, when would I roll up or down a spread that is under attack? It would, in my case, it would actually be based on, what's happening with the stock. If I've got a bear call spread on and the stock's starting to break out to the upside, I would come in and probably, either exit or roll based on my outlook for the stock. Whether I'm going to exit or roll would actually have, would actually, part of how much time we have left to expiration would come into play there as well, depending on what kind of premium you could take in on the option that you're selling relative to the option that you might be buying back. So there are a whole lot of moving parts, and it's just best to have an idea of what you would do at certain time periods in mind before you actually do the trade. So, and then Robert had a question for you. On the,
it helps if I unmute my phone before I start answering.
I do that all the time.
Okay. Well, what I will do, Robert, and actually I'm going to grab the ball back from you, Russell.
Okay.
I'll go back into my desktop. Let's go back in and we'll share the desktop and take a look at that rollover tool. Now notice here when you create, okay, for example, notice that for my July 1941 calls on Coke, I'm actually short 2 of those calls. Well, let's take a look below because you'll notice here that what I'm going to be doing is actually rolling that call, let me see, instead of selling 1, we're going to sell 2. Notice that what I would be doing is rolling that call forward. So here is where you can make that, in rolling it forward, you're closing out your current trade and then either buying or selling the further out option contract, which in essence is that calendar spread. So hopefully that makes it a little bit clearer, but do try it out with your account. And I think that was Robert who had asked the question. Okay. All right, well, we're back in here. Any further questions, please go ahead and enter them into the chat panel right now. And while you're doing that, I also do have a bit of business here, and that's to run a poll. In each of my events, IB's management does require that I elicit some feedback for you. So notice I've just opened up a polling panel with 3 short questions, and I ask that you make your selection. We try and keep it easy. 2 of them are multiple choice. So go ahead and make that selection. And then you can click the Submit button. But also notice that number 2 has an input field, and that's a great place if you've got any comments or suggestions for other webinar topics. That's a great place to enter those because I do review this with my management team on a weekly basis. Now, you're going to have to type quickly because there's only about 5 seconds left in the poll. So if everyone would click that Submit button, I'll be able to compile the results. By the way, if the poll does end quickly, and that's by design, so that we can get back to your questions and any answers that Russell can provide, I do want you to know that you can always send me comments or suggestions to webinars@interactivebrokers.com. It's a mailbox where that too is reviewed by my management team as well. So thanks everyone. Poll did end. I appreciate the feedback. And notice what you can do is simply close out the poll by using the X that's included on that panel title bar. Any additional questions, please go ahead and double-click the chat panel and you can enter your questions there. But I'm not seeing any questions. I haven't gotten any in. Jason was asking, okay, what's the easiest and quickest way to roll a spread position within TWS? Well, Jason, I know why you're asking that question, and that's because for all of your spreads, we actually maintain each individual position in your portfolio screen. So you'll see each individual option contract. Now, if you've entered that spread, depending on where you've entered the spread, if you do create a spread within the option trader, what you will see, and you want to close. So what I'm going to do, and I don't have Option Trader open, but I'm going to grab this back if you can bear with me a minute. Let's go back into TWS, and what I will do here is we'll simply minimize this window. I'm not going to close it. I'll minimize it from here. And let me go into, actually, I'm going to go into our advanced order mode. Where I do have, and you'll see here, let's see, where's my portfolio? There is a portfolio, and notice that I do have some option positions that are currently here. Well, let's go into Option Trader, and here I have one for Cisco, and I'm simply going to open that up. Now, you'll notice there is no spread that's listed here, but what I am going to do is use my push pen and notice what I'm going to do. Notice that as I do have the contracts that appear over to the right-hand side, I think I've got my position field. Yes, let's go ahead. And what I'm going to do here is simply load my chains. And you'll see I've got several chains that appear down below. Let me see if I can launch this. And looks like I've also got the 17 and the 23. Yes, here I've got both positions. Well, notice to quickly and easily recreate that combo, what I am going to do is simply go to the combo tab and let me close out of some of these. And notice here that I'm short 11 contracts, but I'm simply going to click the bid price, and you'll see that it's going to put that combo into my quote panel. We'll go over to the contracts or the puts that I'm long, and notice I'll click on the ask. So here I've just created that same spread, and what I will do is simply add it to my quote panel. Now, I'm going to also add the combo legs. And notice what I've just done is put that spread back into the Option Trader window. Now, once it's here, you'll see the implied quote pricing is also provided. Now, to exit that trade, what I can do, and you'll see here that, and this I believe was a caller that I had working, notice that I can simply left click since I was long this spread. I'm simply going to sell the spread, and you'll see that it's added to my window. By doing this, notice here into the trade management panel that what I've just done is I'll exit the trade the same way. Now, what notice here, I think don't have my quantity set, but I'll go ahead and insert a column here. Let's also add my quantity, and notice that it's just a single spread. So what I will do is transmit that trade. Now, once I transmit here, you'll be able to see that as soon as it does fill, I've just been filled, and notice how that I was able to exit that trade as a spread rather than working through my portfolio screen where I would have to exit each individual position. So hopefully, and I think that was Jason who had asked, hopefully that's what you're looking for. And notice I just closed out a single position here. Okay. Would this also work for rolling over the spread? Well, Varun was asking, okay.
I'm actually going to type the answer to Varun's question. I actually had started typing that.
Oh,
so you
okay.
keep doing what you're doing, and I'm going to type out an answer for you.
Well, okay, good. Jason, I think Jason has found what he needed. Now, also, I did want to mention, you'll notice that I include the the implied quote pricing available here, that implied spread price, is listed within the quote panel of the option trader, whereas in your portfolio, it's a single, each individual contract is included singly. Now, and you'll see that I had to recreate that spread very quickly using the combo tab. That's how you can enter a spread or also exit a spread. But I wanted to mention, notice here, if you do try and close the option trader window, it's going to warn you, because if you close the option trader window, as I have, and that's why the spread was no longer listed. So by simply, what I'm going to do here is not close it and minimize the option trader. That way, you'll notice down at the bottom of the screen on your taskbar, you still have the option trader window open and can go in and exit the spread the same way that you entered the spread. By the way, notice here, if you just to verify spread construction, let me see what I am doing. I clicked on that and I want to tab out of that. Notice that that risk reversal, simply hovering over that is also going to open up a description window where you can verify what you want to do to exit that trade, what it means to buy that spread or what it means to sell the spread. So just another check. Also, when you do go click the bid or the offer price, notice here you can also see that same information is included in your order management row. Okay, well, looks like Russell has answered Varun's question. I see Varun came back with a thank you. What I'm going to do now is take us back over into our main event window for any additional questions. Oh, I see. And since Varun did ask the question, would you mind sharing the answer with us, Russell?
Oh, sure. He was asking the pros and cons of using a LEAPS. I'm trying to find how he asked it. You know, short-term calendar spreads better, worse than trading using LEAPS, and I responded that you know, LEAPS are great because you really do not get hit with your long option on the time decay side. Typically, I'm answering the question and thinking about diagonal spreads more than calendar spreads, which would involve a possibly deep in the money LEAP option that has very, very little time value because it's so deep in the money. And in that case, you can hold a LEAP and opportunistically sell an option against it. And this is actually, this probably, with respect to equities, this is probably my favorite trade, where you have long or short exposure to the equity through either a deep in the money put or deep in the money call that has several months, even maybe over a year to expiration, and opportunistically sell calls or sell puts against that position based on a short-term outlook for the stock. So, you know, continue to try to take in some income through through short-term time decay, and maybe have some directional exposure, either long or short, with very little time value to that directional exposure. So,
okay. Russell, I also got a question here about your stock chart and the actual points to make those rolling option choices, and they were missing in today's presentation. We actually have had some challenges with some of the charts recently, so Terrence did notice that, so I just wanted to make note of that, and we'll try and get them back in. We've had a few challenges with this WebEx platform. form.
Yeah.
But
I thought I had it this time. I guess not. I thought I'd figured it out, but I guess not.
Well, we'll get back to it. I think we've got a way, a workaround, so I'll be working with you on some upcoming presentations, of which I'd like to also mention that Russell will be back with us next month. Coming up on June 19th, Russell will actually be talking about portfolio risk analysis. So excellent. I can't wait for that one, Russell. Now, Varun was also, and by the way, it is listed on our website underneath the education menu. You'll find a webinars link, and with our live webinars, simply scroll through there and you'll find access to Russell's upcoming presentation. Now, Varun was also asking about how to roll over a spread in Trader Workstation. Now, remember, Russell, in TWS, we do maintain each option position as a separate contract within your portfolio. So you would still use that same rollover tool and roll over each individual contract within that spread. So you have the ability to either roll only one contract, as Russell was displaying here today, or by rolling both of them. But you would do that through that rollover tool as well. Russell,
Jason was
actually,
asking personal site. No. if I had a personal website, I would get in a lot of trouble.
But you also do a lot of tweeting and a lot of blogging. Can you give us that information as well, how
sure.
to find you?
The best way to find the CBOE blogs, and I write between 5 and 10 a week, mostly VIX-oriented, is just through this link right here. And then, my Twitter is this, and I just tend to I have to, because I work for an exchange, just for full disclosure, I have to be very careful about not making recommendations, just pointing out other things people are saying. So I'm supposed to be all about education, so I have to be very cautious sometimes. So I will retweet things that I find interesting in an educational manner. We'll leave it at that.
Well, Russell, thank you very much for the time that you put in for all of these events. We certainly do appreciate it. And coming up again, now Russell has agreed to be with us for the remainder of the year on a monthly basis. And usually we have them scheduled on the Wednesday preceding Expiration Friday for each month. So do check our webinar calendar. And I also want to thank the CBOE for making today's event possible. It's their dedication to educating traders that has brought you our webinar series this year. So, Russell, thanks to you and thanks to the CBOE. And by the way, I can't wait to tune in to your blog later on this afternoon.
I'm looking forward to that. That's going to be great.
It will be. Well, and here we are right on time, and we have come to the end of today's webinar. So that is going to conclude our presentation. Jesse was asking how to see volatility in Trader Workstation, and actually, Jesse, I do go through that in our Option Trader webinar. We have one of those that is specific to IB's technology. It's coming up on June 5th. But if you don't want to wait for that, there's also recordings from last month's, or this month's, I should say, Option Trader webinar that are also available. Simply check the Interactive Broker website underneath Education. You'll find a webinars link, and there's actually a button to register for upcoming webinars as well as to view any of our recorded archives. So please check that out as well. And that is going to conclude our webinar today. Thank you, Russell.
All right, thanks a lot.
And I look forward to hooking up with you again next month for another great presentation on risk analysis or portfolio risk analysis. So thanks all. Have a great afternoon, and please trade smart.